What do I think is going to happen? I think we're going to have a major bear trend. And I think it's not so much that the stock market goes down, but economic reality exposes itself, errors, failures, and so forth. And once you get a market downturn and the personal pain that goes with that, like we've been talking about, personal debt and so forth, you get this sense of desperation where it's hard to predict what the outcome's going to be, but I bet it's not going to be just another boom bust cycle. It's going to be something far more lasting.
Markets are often judged by their peaks, but it is the structural foundations that determine their fate. Today's financial environment is one of stark imbalance, exuberant index levels on one hand and deteriorating economic internals on the other. The S&P 500 and NASDAQ have reached new highs, yet participation is narrowing, volatility is returning beneath the surface, and multiple sectors remain in stagnation. The illusion of broad-based strength persists, but it rests on a thinning layer of speculative momentum and liquidity assumptions, not on sustainable economic conditions. This episode examines Michael Oliver's latest warnings, not from the angle of price targets or short-term trades, but through a broader lens, the unwinding of a multi-decade paradigm. His analysis moves beyond familiar critiques of overvaluation. It addresses the disintegration of coherence between asset prices and real economic performance, and the erosion of public confidence in key institutions. The forces at play, distorted capital allocation, excessive leverage, and prolonged policy error, have created an environment in which market metrics can no longer be trusted as accurate reflections of underlying conditions. At the heart of this moment is not just the potential for a financial correction, but the reemergence of risk in domains that were assumed to be stabilized: sovereign credit, corporate funding, even the continuity of fiscal operations. The transition now underway is less about volatility and more about exposure. Latent fragilities are becoming visible, and the institutions tasked with managing them, central banks, regulators, and legislatures, appear increasingly constrained or unwilling to act decisively. The system is no longer converging on a solution. It is diverging toward conflict between classes, between policy mandates, and between political expectations and economic limits. Michael Oliver's thesis, examined in the following segments, is not simply that a bear market is approaching. Rather, it is that the conditions for a systemic transition are now fully in place. This is not a temporary interruption of growth or a miscalculation in policy. It is a structural unwinding. As the data erodes and the narratives falter, what remains is the reality of widespread overextension and the growing recognition that this time, the consequences may be both enduring and transformational. Before we begin, if you're looking for objective, data-driven market analysis that goes beyond the headlines, subscribe to the channel and turn on notifications. We examine markets not through sentiment or media spin, but through structural signals and macro realities that most analysts ignore. If you find this content valuable, please like and share. It helps keep critical insight in front of those who need it most.
I mean, obviously.
Oh, yeah. No, I'm not sure how deep the market will go. I mean, you could go back and look at history 29 to 32. I mean, it's like an 80% wipeout ultimately. And it began with a crash and then came all the way back up, halfway back up into March of 1930, and then went down slowly for 2 years, but an 80-something% drop. And it took until 1953 to even get back to the nominal price high the Dow saw in 29, not counting the degradation in the money unit. Similar thing happened in 2000, by the way. People think, oh, wow, the stock market made a low in 2002. Great. But in 2013, for the S&P to finally take out those highs, the 2007 highs and the 2000 highs. So you had a decade and a half almost where the market was a wasteland, really, in a range. Anyway, I think we're headed into that, and I think there'll be real world consequences. And one thing we said about a year ago is we thought, well, if Trump wins, a couple things are likely to happen, but one of them is likely to be uncopacetic in terms of public response. And I mean, the opposition. rather than sitting back on their haunches and waiting for the next election cycle. I suspect if we get economic downturn now that is noticeable to the average Joe, something he thought Trump wouldn't bring on, Trump is going to save the economy. Well, if all of a sudden that doesn't happen, then emotions come into play, sense of uncertainty. And when that happens, and we know people are hurting on their credit card limits and so forth and so on, we know these data points. We know commercial real estate is in a stranglehold right now. In fact, we had the biggest shopping center in the country. I think it was an $800 million default on debt 2-3 months ago. Wasn't a headline, but it happened. That you can get uncopacetic things in the street as well.
And okay. And by copacetic, you essentially mean civil unrest, correct?
Yeah. In fact, there have been polls done by University of Virginia Department of Politics about 2 years ago. It was. They polled both likely Biden voters and likely Trump voters. If the other side wins, is violence justified? And it was an incredibly high percent, like 20-something% on both sides. And yes. If the other side wins, is that the end of democracy? It was like a 40% odds on both sides. Yeah. In other words, this wasn't a normal election. We're at a point now, if you throw into the mix economic pain and suddenly a sense of disbelief, like, well, we thought, Trump got labor vote, he got to low income vote, who thought this guy can probably solve our problem. He's sort of down to earth. And if all of a sudden that turns out not to be the case, not so much because of what he does or didn't do, it's what has already happened. He just stepped into it. If that unfolds, as we argue it's likely to, then a sense of emotional disbelief occurs. And that's when you get that uncopacetic, unpredicted outcome where all the norms aren't there anymore. And so that's another element that I think is probably we're going to see it this year, especially if we're correct on the stock market, relapsing from a new high, like it did, by the way, in 2007. You made a peak in May. Where was it? Back at the same price as the 2000 bull market peak, 1550 on the S&P. You dropped from May to August, a hard drop, just like we had January through April. Bernanke during that time denied that there's any problem with the mortgage markets. It's totally controllable, he said.
That subprime is contained. Yep.
Yes, right. You remember that. And the market turned up in August, September, moved back toward the high. And in mid-September, he cut rates by 0.5 point. Surprising rate cut, by the way. Was not anticipated. The market shot up for another 3 or 4 weeks into mid-October, taking out both the May high of 2007, just above 1550, and the 2000 high, just above 1550. It got up to 1575, like 1.5% into a new high. Fed rate cuts, everything's going to be great. That was the end of the world. We went to hell for the next 2 years.
Yeah.
And reality hit. We had a mortgage crisis. Now it's probably not a mortgage crisis so much as it's a corporate debt crisis and other issues. But same story. Don't be teased by a new high.
I believe that we have somewhere around close to $1 trillion re-rating this year and similarly next year. Is that when you expect a corporate debt crisis? Is that the main trigger? Is that the balance sheet is re-rating?
It's been a trigger. Yeah, it's been underway actually for a couple of years. If you've seen the movie The Big Short,
sure.
You remember they had 3 or 4 guys, separate parts of the country, analysts, independent of Wall Street, who came up with the same conclusion that shit's going to happen. Okay. In other words, this is built-in crisis. It's going to happen. They knew it was going to happen. They could see it coming.
Right. It was math.
Yeah. But look how frustrated they were. They were seeing this in 2005, 2006, 2000. It wasn't until 2008, even after the Fed cut rates finally, that it began. And they were right. So you can have that crisis, for instance, the long end of the bond market, the 30-year bond futures we look at. We got bearish on T-bonds back in October of 2020. Then the T-bonds were above 170. Between 2020 and late 2022, they dropped down into the 110, 115 zone.
Mm-hmm.
A huge collapse. A lot of it occurring late in 2022. But since late 2022, you can draw a line sideways on price, and you've done nothing but this. In other words, it's been in a choke zone in terms of yields really dropping. They haven't dropped, they've stayed high. And of course, the yield chart would show it the other way, up, at high levels.
Yep.
But it's not that they have to go higher to choke people. They're already choking. It's just that they won't relent. And as you said, maturity, 2025 and 2026, as I understand, is likely a time for a lot of these debts to be exposed in terms of the ability to pay or not. And so, we could be nearing that crisis. And yet it's been a reality that's been there for a couple of years. It just won't go away.
Historical context often reveals what contemporary analysis misses. The market collapses of 1929, 2000, and 2008 were not random dislocations, but symptoms of deeper structural excesses, each time fueled by credit misallocations and policy delays. What distinguishes the current cycle is the simultaneous fragility across multiple debt layers. Unlike previous downturns, this one does not feature a single point of failure. It is systemic in nature, with stress accumulating quietly across balance sheets and national budgets alike. The maturity profile of corporate debt has shifted dramatically. In the wake of prolonged low interest rates, many firms accelerated borrowing at terms that are now expiring under drastically different conditions. With refinancing costs rising and margins thinning, the strain on corporate liquidity is beginning to surface. But unlike the early 2000s or post-2008 environment, the public sector's capacity to absorb private sector shocks is now far more limited. The fiscal position of the U.S. government is constrained by political gridlock, ballooning deficits, and a sovereign debt market that is showing increasing signs of instability. Meanwhile, household resilience is deteriorating. Credit card delinquencies have returned to pre-pandemic levels, personal savings rates are near historic lows, and inflation-adjusted wages have remained stagnant for much of the population. These pressures do not just affect consumption, they influence sentiment, political volatility. The result is a convergence of financial stress and institutional doubt, a combination that historically precedes not just downturns, but structural breakpoints. In this environment, Michael Oliver warns that the next market decline may not follow the familiar path of monetary rescue and gradual recovery. Instead, it may accelerate a chain of events that includes sovereign credit repricing, institutional breakdown, and public disorder. The key distinction, as Oliver argues, is not the scale of the correction, but its permanence. What comes next may redefine not only portfolio strategy, but the foundational assumptions of the global financial order.
Do we have the sort of triple whammy of debt stress, both on the consumer, the corporation side, and the national side?
And the national side too, which
is the sovereign side, yeah.
That's even bigger. And the T-bond market is, that's the government debt, okay? And you look at that chart and say, this guy has tried to get up out of here so many times in the last 3 years, get a rally going, drop rates, rally the price, and they've all failed. We had a good rally going, for example, back in Jan, Feb, March, April of this year.
Mm-hmm.
Bonds rallied from like 114 to 121 very sharply. Nice rally. And thought, oh boy, we're on our way, right?
Yeah.
Within 2.5 days, it was back down to 111. That's a crash. What happened? I mean, you can't do that with the government debt market. The central bank has to be panicked to the point of wetting themselves without admitting it publicly, of course. They thought, oh, everything's fine, Well, the government debt market is not. And so you now have a problem you didn't have in 2008. Now it's come to the fore. I mean, so many decades of this error compounding and compounding. And even Trump has increased the situation. The debt is increased under his budget. So they may be talking about it, as you said, but nobody's doing anything about it. I think we've got a crisis coming, and it's not just stock market, but it's in the real world. And I think that crisis this time around, unlike 2000 to 2002 or 2007 to 9, is going to create the kind of changes and uncertainty and up in the hands type response by everybody, like what the hell's going on type thing, to where we're going to lose, which is fine with me, some institutions that have been around for 100 years. I'm betting you won't have a Federal Reserve. Not because Trump doesn't particularly care about it one way or the other, and a lot of Republicans don't, but because it's dysfunctional. And there's a lot of people realizing it's really been a boom bust cycle generator. Not just the Austrian School of Economics, but others are saying, this really thing hasn't worked well. They're always behind the curve, et cetera, et cetera. I also think if you see that pinching effect that you're talking about, or the choking effect of debt, particularly personal debt, income taxes are in question. Not so much because some Republicans just soon get rid of it anyway, but because it's dysfunctionality in terms of the source of government revenue, which it's become more and more every year in terms of the revenue that it generates as what was expected is less and less. And there's a point at which people simply say, oh, I have to request a delay, or, oh, I need a plan. I'm driving around town and I'm listening to Sirius radio, whether I turn on CNN or Fox Business News or whichever. There's constantly ads about we can help you with the IRS.
Mm-hmm.
That's like 50% of the ads. Well, I didn't know there was a problem. Well, yes, I do. But I mean, that could be the kind of crisis where all of a sudden income taxes are abolished. Not so much because they intellectually like the idea to do it, it's just that it's dysfunctional. And they revert to a national sales tax. Let the shopkeeper collect taxes for the government. All these kind of changes could occur. And I don't think there'll be a surprise. There'll be a surprise for many, but I think this is different this time. I think the world, it's not just the US. I think a lot of countries are going through major change, or about to, especially if we enter the kind of crisis we're talking about with the stock market down, the data points will go with it. Day-to-day life will change, much like it did in 2007 and 8, if you recall. Mm-hmm. Argentina is an interesting example. The president of Argentina, elected like a year ago, Javier Milei, is an anarcho-capitalist. And he busted both parties in the election with the youth vote. And a lot of the vote that he got to become elected president was desperation, especially young people just throwing their hands up in the air saying, this stuff hasn't worked for decades. This two parties back and forth, still a socialist state, turned Argentina into a third world country, used to be the 7th biggest economy in the world, 50, 60 years ago.
Right.
And then he comes in and what is he doing? He's abolishing stuff. He got rid of rent controls. Suddenly rent prices have collapsed, which makes him happy. But he's throwing away notions that have been around for decades. He's tossing them. And it's sort of an emotional, not on his part, he's an intellectual, but on the public's part to vote for him. It wasn't like they read what he thought and understood it. It's just that they knew we need to get rid of these two competing parties, which have brought us nothing but ongoing decay. And once you get a market downturn and the personal pain that goes with that, like we've been talking about, personal debt and so forth, you get this sense of desperation where it's hard to predict what the outcome's going to be, but I bet it's not going to be just another boom bust cycle. It's going to be something far more lasting.
What distinguishes the crisis we are now entering from every financial dislocation of the past century is its totality. In 2000, the pain was largely confined to overvalued tech equities. In 2008, it was the mortgage and banking sectors that buckled. In both cases, the sovereign and monetary systems were still seen as credible backstops. That is no longer the case. Today, stress is cascading simultaneously through corporate balance sheets, household credit, and the sovereign debt complex. The very institutions that were once used to cushion past collapses are now among the most fragile components of the global order. This is not another cyclical downturn. It is the exhaustion of a global financial model built on ever-increasing leverage, policy intervention, and fiat illusion. The monetary tools that central banks once wielded with confidence have become blunt instruments. Trillions in liquidity injections, zero-bound interest rates, and relentless asset purchases have failed to produce real growth. What they have succeeded in doing is distorting capital allocation, inflating asset bubbles, and deepening systemic dependence on artificial stimulus, a loss of confidence not only in markets, but in money itself. In such an environment, gold and silver are not merely safe havens, they are the exit strategy. Unlike stocks, bonds, or digital promises, they are not someone else's liability. They require no central bank to validate their worth, no legislature to enforce their value, no algorithm to sustain their existence. They have survived every failed currency regime in recorded history. As fiat currencies continue their structural devaluation, and as sovereign debt markets lose the perception of risk-free status, a new monetary standard will be required. That standard, whether implemented formally or simply adopted by markets through behavior, will be anchored in tangible, finite, trustless value. Gold and silver are not just insurance. They are the future reserve assets of a world in transition. What Michael Oliver is outlining is not simply the collapse of price structures, but the end of a belief system. The belief that governments can borrow without limit, that central banks can intervene without consequence, that cycles will always repeat and bailouts will always arrive. This time is different, because this time, the system itself is breaking. And when systems break, gold and silver are not just beneficiaries, they become foundations, not by speculation, but by necessity. What lies ahead is not a recovery, but a revaluation. And in that revaluation, the most undervalued assets on the planet today may emerge as the bedrock of a new financial era. If you understand what's coming, not just a market correction, but a complete redefinition of money and value, then positioning in physical gold and silver is no longer optional, it's essential. This channel exists to help you navigate that transition with clarity, conviction, and facts, not fantasy. Thanks for watching, and see you in the next one.